Hello and welcome back to Bunnex Investment Group. In this video, we are going to talk on how banks trade, right? Everyone really wants to trade like a bank because trading in line with banks has higher probability of success, but it doesn't guarantee that you are definitely going to make money out of each and every trade that you take. But before we jump into the whole video, make sure you check out our free Telegram channel. The link is right in the description box below. So, how do banks trade? Banks are actually companies that have access to large amounts of capital. So, if they decide to buy any particular security, maybe it's USD against Swiss franc, they have to do that with high caution. Otherwise, they may collapse the market or actually review their decision to retail traders and ultimately lose that particular position. So what they do is they need to spot points or price points that they wish to actually inject their capital. So what do I mean by that? Let's say a bank, right? Let's give that bank a name like Bank A. Bank A wishes to buy this particular pair at 92 cents 14.0, right? This is this price point at 92 cents 14.0, just a dummy price that I've just come up with. So let's say they buy. When they buy, since they have access to large amounts of capital, it actually affects on the markets as sharp rises, right? They can alter the demand of a particular currency in their pairing. So if they buy, we usually experience a sharp move of price. However, if they wish to buy, for example, 100,000 units or 100,000 portion of USD CHF, they have to do that with caution, as I have said earlier. 100,000 portion of USD CHF will actually lead to the market probably collapsing or giving a false demand to a particular currency. So what they do is they will have to split their position, right? 100,000 is the decision to buy on that particular pair. They split their position into two portions, say 50,000 and 50,000. So they inject their first 50,000 or open their position of 50,000 portions at 92.14.0 the price. Then later on, since they have an ultimate decision of actually buying 100,000, they will need to actually participate in cyclic trading. By cyclic trading, we mean another bank has to sell for them to return to the same price that they actually bought in the first place. So on that same price, that is where they will actually inject another portion to make it 100,000. So with that is how what we call order blocks come into rise up on charts. They are basically points where institutions have their orders and wishes to add more orders within their particular position. So by that, how do we see these order blocks or these points where banks wishes to add more positions and trade in line with them? The only answer to that is it's not highly accurate to actually pinpoint these points, since we are actually trading or following someone else's pattern. So the first, actually the only sign that we may see to validate these points where banks will actually inject more positions is to look for points where there are sharp rises or sharp drops, as an evidence that there has been injected a lot of contracts, right? So let's look at this point, right? We may see that from this point we had a sharp drop of the price, right? So this sharp drop is not something that was driven by retail traders, as retail traders are confused. In fact, not I wouldn't want to say are confused, but there are a lot of tags within the flow of market that is driven by retail traders, up, down, and so forth. But if banks are now involved, usually we will have sharp rises or sharp moves of the market. From this point, we can see that there was a sharp move. Therefore, we have somehow evidence that from this point there were positions that were opened, right? Then from this point we had another sharp drop, straight run from this zone to that zone, and we know that there was actually more contracts that were added at this point. So how do we use these positions in the future? We basically protrude those zones into the future. And where do we protrude them? We protrude from the last up candle before the down move, or from the last down candle before a sharp up move, right? So I love to use rectangles to mark the high and low of the last up candle before the down move. So in this case, we can say the last up candle was basically this one before the down move. Therefore, this was a point where they could come back to tap in or add more positions to the first portion, right? Then we can see that the last up candle was this one, the green one at this point, right? That we have protruded into the future like that. Therefore, they had to add more positions at this point. So mind you, this is an H1 time frame, which is basically a median time frame. We don't categorize it on higher or smaller time frames. So it all depends with your strategy on the take profit as well as on the stop loss side. So at this point, we can see that they injected sharp move and they had to come back to add some more positions, and later they had to achieve this particular price point with these two positions in total, right? Then after that, we can see that the market went up a bit, but later after that we can see it going up with a sharp move. There were straight running candles. I love to call them knives. There were knives going up like that. So the last down candle before the knives came into play was this red candle, right? Therefore, our order block was this one. They had to come back and inject more positions, and the market went up, right? After that, we can see another sharp or knives again. There were knives going up to this zone. Therefore, what is the last red candle before the up move? It was this one, right? So therefore, this was an order block, and we can see that the market went to tap in that zone, and although it was a small move like that, right? Then later we can see the knives again on the charts, right? So I want you to differentiate the move of this manner and the move of this manner. So this move should show you that something is happening. There are now retail traders who are actually confusing the market, but when they actually accumulate and so forth, they actually move very fast like that, right? So later, the last up candle before the downward move was that one. It was a small candle. It was a small candle like that, and after this, these knives, they came back, right, and the market went down. So can we spot any knives in this zone? Yes or no? We cannot see any knives. But from this zone going down to this point, what can we say about that? What we can see is there were knives. There were these small knives, and the last up candle before that downward move was this one, right? Therefore, we had an order block that was later tapped in to introduce more positions as they went downwards, right? Then later, at this point, we could actually say we had some knives at this point, right? But then later we saw that it was violated later. So at this point we had the knives, and the last upward candle before that downward move was this green candle. It was actually a hammer, so marking the high and low of that hammer. We could see tapping in of positions at this point. So basically that is how you spot points where there are order block, or where there are orders, bank orders. So in short, trading like banks is actually spotting the knives, like how I've nicknamed them. Spot the knives, mark the last candle before a downward move, or the last candle before an upward move, and wait for price to retest that point. That point is basically a high probability point where banks are now injecting their second portion of trades, or their third portion of contracts, sorry. So that is how you trade in line with these guys. On that note, we come to the end of this video. Thank you for watching. Like and subscribe, and if you have any questions, please tell us in the comment section below.